Bless Squad, what's going on with y'all, man? It's your boy, Blessed Applesauce to the Bless Show with another video here on Blessed Doing Best. And today we're here to talk about the best indicator of all time. Really, indicator-wise, you really don't need any other indicator other than this one if you're trading. And this one is the moving averages. You're going to hear this a lot on different YouTube videos. People probably talked about it. Oh, get this moving average. Oh, get this 50, get the 100, get the 200, etc., etc. So in this video, I'm going to break down like what is the best one to go for, what they do, and how to use them effectively to ride trends and capture the most out of the market and be consistently profitable in this game. So before we get into it, make sure you spam the like button down below and also sub down below for more content like this. So getting into it. So this platform right here is Thinkorswim. If you are not familiar with it, it is with TD Ameritrade. So I'm actually going to show you how to actually put the moving averages on there. So you're going to go to Edit Studies, and then you're going to go to SIM. Boom, simple moving average. So with this, they have two. So I'm going to show y'all what each of them look like now. So we're going to throw the simple moving average on there. And we're going to throw the exponential moving average. We're going to throw both of them on there, add selected. So that's how you do it on Thinkorswim. You just type it in, and we're going to make them different colors so we can tell the difference. So we're going to make the, which one is this one? This is the simple moving average. We're going to make this red, and we're going to make the exponential moving average. That's going to be blue. So with the simple moving average versus the exponential moving average, there's going to be a subtle difference. So I'm going to apply them, hit apply, and we're going to see exactly what it is. So when we zoom in, we can see the red line, the simple moving average, and then this blue line, the exponential moving average. So all moving averages do is they track the overall trend. They take the average price of the stock. So you see how it's hugging the stock as it moves this way. It's closely hugging the stock, and all it's doing is getting the average price of a certain amount of candles. So with this one, this is going to be, these are two nine moving averages. So with the simple moving average, it's going to track the average price of the last 9 candles. So you go 1, 2, 3, 4, 5, 6, 7, 8, 9. The average price is here. And you go 1, 2, 3, 4, 5, 6, 9. Average price is going to be there for the last 9 candles. Simple moving average. That's how it's calculated. Average price of the last 9 candles. With the exponential moving average, they're going to do the same thing, but it's going to weigh the most recent candles a little bit more. So as you can see, the exponential moving average is a little bit tighter than the simple moving average because it's weighing the most recent candles a little bit more. So with this, you can see how it's following the overall trend. When this starts to go down, when the moving averages start to turn down, the stock tends to turn down. When the moving average is turning up, the stock tends to turn up. So people use this as an overall guide to see, okay, where's the overall trend? You probably heard a lot of people saying the trend is your friend. So the moving average is a simple way of figuring out what direction the trend is on. If the price is over, if the candles are over the moving averages and the moving averages are pointing up, the trend is up. If the moving averages are pointing down and the candles are below the moving averages, the trend is down. Very simple. So there's a lot of different ways to go about using moving averages. I'm going to show y'all a couple of moving averages that are very common. The ones you're going to run into a lot, as you can see, this is the 9 moving average. You're going to run into the 9. So we're just going to get rid of the simple moving average just to make it a little simpler for everybody. So we're just going to stick with the moving average exponential. And what I'm going to do, I'm going to add 1, 2, 3, 4, 5. And all I'm going to do is change the length. So the length is going to change how far it is. We're going to change this to 20. Make the 20 purple. We're going to change this one to 50. We're going to make this one, let's make this one red. We're going to change this one to 100. And let's make that yellow. Okay. And then we're going to change this one to 200. Let's make that green. Okay. So when we apply, you can see when we change the numbers of the moving averages, the length of the moving averages, it now has a different calculation behind it. So this blue one here is still the 9 moving average, where it's taking the average price of the last 9 candles. But this green one right here is now taking the average price of the last 200 candles. So with the 200 candles, the average trend is going to lag a little bit. You're gonna be able to see the overall trend. It's not going to capture every single move that the market is going to do. So as you see with this 9 moving average, where it goes up, down, this one is more consistent, where you're able to capture the overall trend. So if you're looking on a long-term standpoint, you're going to want to look at the longer moving averages, and the most common ones are the 100 and 200 are the long-term moving averages to show you, okay, the trend is up, or the trend is down, or the trend is in this certain direction, and you're able to understand that while you're getting into moves. And it makes you feel a little bit more comfortable, like, okay, I'm in this trend, it's going in my favor, and I can stick in this trade because it's going in my favor. So next thing I want to show y'all is how to time your entries with moving averages. So let's look at the yellow one, for example, this yellow one here. Notice how when it bounces off of here, this massive drop right here, it bounces right onto the moving average. Boom, right into the moving average, bounces back up. You zoom out. Dropped into the moving average, bounce right back up. Drops into the moving average. We currently have that here, drops into the moving average, and it tends to bounce back up. So what people will do, and this isn't the most perfect chart to show this, but what people will do, they will buy their trades off of moving averages because they tend to act as support levels. Because a lot of people will look at these levels, they'll say, okay, this is a long-term trend. A lot of people are looking at this, and this can be a potential buy point, and it will tend to bounce off of these trend lines. Of course, you want to confirm. Of course, you want to confirm with some. Let's decline that real quick. Of course, you want to confirm with like trade signals and candlestick patterns to confirm before getting into it. But as you can see, the trend tends to bounce off of these moving averages here. So you're able to get in, boom, got in, made what? Cool, like 10% off of this, got in right here, boom, got in right here, boom. And then you just manage your risk around it. Put your stop loss down below. Let's say you put your stop loss below the 200. If you get in at the 100, you put it at the 200, and you're able to capture the gain as the trend is going up. This is a really simple strategy for long-term trading. Really effective. You buy on the 100, you put a stop loss at the 200, and you know the trend is in your direction because it's been consistently going in this direction for so long. So that's one simple strategy that you can use to time and get into trades, which is really effective. Moving average wise, you just need to put some risk around it and you should be all good. The reason why this works so well is because all you're doing is just getting over the path of least resistance. You're going and picking a stock that is already up. The company's generally pretty good. This is Walmart right here. This is a strong company. And if you can see over the past 200 candles that it's been doing very well, odds are it will continue to go in that direction. So you're betting on continued prosperity in a company, and all you're doing is buying at the dip. So this one is really nice. I highly recommend using this this strategy and using this indicator to understand what direction the stock is going in, understand the trend, and get a feel for, okay, I'm in the right direction, I'm in the right play, because overall, long term, this thing is working out in my favor. You can also use this short term. For short term, you're going to want to use the closer SMA, EMA indicators, where they're picking up more short-term patterns. So if you wanted to trade this more short-term, let's say you want to buy off the 9, boom, it tags into the 9, it pushes up, you capture that gain. So you can also be creative how you want to play this. You can tag it from the 9, you can tag it from the 20. It just is based on your time horizon, what type of length of time you're looking to hold a trade. Of course, put some risk around it and back test it, but that is how you capture and get the understanding of the overall trend of a stock. If you have any questions, let me know down in the comment section down below. I can share, I can answer some questions for y'all if y'all have any. But that's gonna wrap it up. It's me, your boy, Blessed Applesauce. Stay blessed, and I'm gonna see y'all next time on Blessed to Invest.
Just to see tomorrow is a blessing. Stay prayed up is the message. Everything about a nigga blessed. Everything about a nigga blessed.